Hello everyone and welcome to BFW 2401. This is an explanatory video for test 2, which will be held on this coming Thursday, the 20th of April 2023. Now, in this explanatory video, I will explain the areas, the structure, and some comments. Please follow with me. On Wednesday, I will have consultation hours from 4 to 6 p.m. So please be there if you have any questions, and also email me if you have any questions about the test. Now, the structure, as I explained it, let me share just my screen. The structure, as I explained it before, it's like this. So we have, as you can see, this is the structure of the test, 20th of April, 2023. Now, we will have 50 minutes. The exam contain calculations and theory next. But if you come to the structure, I tried to make it 7 questions for loan sales and securitization, which is week 3. Bank performance, 8 questions, and I think around 10 questions for the bank capital planning. So we are talking about 25 questions, and you have 50 minutes and 5 minutes for reading. If you haven't seen and studied the lecture slides, scan them and see them. I think all of you have looked at those slides, listened to the recordings. And I have 2 old tests and the additional questions of week 3, which is a workshop. Now, this workshop, we didn't have it, but I already uploaded for you in the as one of the resources for this test. Now, let me start with loan sales and securitization. In loan sales and securitization, we talked about the loan sales, and we actually focused on sales with recourse and sales without recourse. And I think the tutorial explained some of the issues, which is very important, which means when we can sell with recourse and when we sell without recourse. Remember, when we talk about the selling with recourse or without recourse and the loan sales, we are talking from the perspective of the bank as a seller. Now, a buyer can be another bank or can be another party who's interested to collect later on. So, yeah, so if there is, the bank needs to sell with higher price and, of course, low return if they can. So, end of the day, the dollar value of what the present value of the loan sales is what matters to the bank. The higher, the better. And of course, there is a credit risk when we sell without recourse. So we have to compare between selling with recourse and without recourse. And I think we have discussed this for question specifically, question number 1 and tutorial number 3. Now, other than those concepts, which means the sale with recourse or without recourse, there are some multiple choice questions which test the theory, but the calculation is only will be similar to that question we have in tutorial number 3, which is number 1. Now, in securitization, we have the pass-through, and the pass-through we have talked about it. It's the normal one before we break the security to classes or tranches. So the pass-through, as you see, mostly we will ask about the calculation of the payments. Now, when we calculate the calculation of the payments, sometimes I will give you the return, or sometimes I will give you the return and some insurance fees and some collection fees for the special purpose vehicle. So you have to take out those fees from the return when you do your calculation. Remember, for loan sales, what we are looking for, it's only one formula. We are looking for the present value, and the securitization, we are looking for the payments. Now, the pass-through is very straightforward, and you can see it here. I think if you look here, this is actually the pass-through. This is the CMO, but this is the pass-through. And the pass-through is actually explaining everything in this slide, if you can look at it. I think we talked here about assumable mortgages and not assumable mortgages. And our main concern here in the repayments and what we do with the prepayments. Now, these prepayments is an important issue when we do securitization because it disturbs the flow of payments from the borrowers that goes to the special purpose vehicle and then goes to the bondholder. So we need this to be always coming in time and complete, but sometimes we will have prepayments. Why these prepayments happens? Because people either retire their loans or they move from one city to another city. So there is something called assumable mortgages. When there is some assumable mortgages, there is no disturbance for the repayments because the seller, the current holder of the mortgage will sell it to another person, and another person will assume the payments. This is what we call it assumable mortgages. So please concentrate, and I mean, take a point of a note on that. The other thing is, this is only one class, but when we talk about this is, for example, this is what I think this is also one of the questions you saw it in the old exams. Please understand the difference between why do people do prepayments? Because the current rate is cheaper than the original rate. If they take a loan with 8% and the rate now is 4%, usually customers will go and retire the old loan and take a new loan. This is where the prepayments happens because of the changes between the original rate and the current rate. And this function actually explain it. And this is also one of the questions in the old exams. You can see it. But when we talk about the CMO, we have classes, and I want you to be aware of those classes. What is class A, class B, from a theoretical perspective, B and C, and then we have class Z and we have class R. And maybe you will have a multiple choice question, what is class C or class R. You have to be aware of this. Now, the issue with the CMO, which has been actually discussed with some students, is this table. When we did the calculation, there was so many questions about the, we will have no problem with the CMO, but with the pass-through. But when we break it like this table, there was many questions, and the book the old book and the new book dealt with it differently. So we are talking about this prepayment, whether it is fixed or going to take this manner of decreasing. Because of these differences, I am not going to test you on the calculation of the CMO. So please ignore it because of this. I don't want to confuse your students in this stage and for this test, but no calculation for CMO in this test. There will be some theoretical questions only. And these theoretical questions would not talk about the calculation. It will talk about some other things. So please take note of this. Now, the other thing also is, I think, let me see, in securitization, we have what we call the loan payments. And I think we haven't discussed this in the tutorial, but I added for you this workshop, and we talked about something called the weighted average, which is this issue. If you look at this, all those questions are actually interesting, and please be aware of them. Just this issue, which has some calculation which is the calculation of the WAL. And the WAL is the weighted average life, this one. Now, the weighted average life, I calculated according to this problem, and I find this, for example, this one find it to be 3.35 years, while the loan is actually 4 years. Let me make it easier for you. If I have a loan, let me take this sense. If I have a loan of 5 years. Now, 5 years, for example, year 1, year 2, year 3, year 4, and year 5. And this loan is actually 5,000. So it has to be paid in 5 years. Now this, and if it is 5 installments, for example, this is 1,000, and then you have to for example, to pay it in 5 installments like this. Now, for example, 1,000 here, 1 here, and 1 here. This is just the principal paid and each year. Now, this is like when we talked about a little bit when we talked about the duration model. So now here this is the payments every year, and this is the payments time t. So you multiply this by this. So this is 1,000, as you can see. This is 2,000 because 1 times 2, and this is 3,000 because 3 times 1, and this is 1,000 times 4, which is 4,000. And this is actually 5,000. Now, what we do is we actually divided this, the total of this. If you take the total of this, you will find it to be 5,000. And this is actually 15,000. So the WAL now is actually divide the 15,000 over the 5,000, and you find it 3 years. So it's 3 years instead of, so if you see a question like this in the exam, please calculate the WAL in this manner. This is the WAL as you see now, this is the WAL, and I want you to calculate it according to this manner. So the WAL is 3 years, while this loan is actually 5 years. And the WAL is actually the weighted average of repayments of this loan if you take the cash flow of it. This is the only question maybe we didn't discuss in the tutorial, and I explain it here. Now, let me go back to the other things. I think the rest are okay. So you can talk about securitization versus benefit versus cost. This is over there. We talked about average, mortgage, assumable mortgages, cost benefits, prepayments, and that's all about securitization. Now, let me go to week 4, back performance. And back performance, we have to understand that there is a different balance sheet structure between financial intermediaries like banks, insurance companies, and any other financial institutions, and the usual corporate firms. Now, this different balance structure, because of this financial intermediation, when we take the deposits, we call it liability while it's a deposit. And when we give a loan, it's a loan, and we are just working as a middleman, but actually when we talked about it, we consider it as an asset. Therefore, when we come and calculate the financial ratios, like the leverage ratio, and the other ratios, we will find actually differences. When we calculate the ROA, when we calculate the leverage ratio, when we calculate average multiplier, all of those leverage multiplier and all these things are different. And this is why we have to take into considerations the difference. So please understand what is, how we can calculate this. And when we talk about actually bank performance, we concentrated on something called the ROE model. Now, the ROE model, please understand how to calculate it. How to calculate the ROE model or the DuPont model. If there is questions, you have to be aware how to calculate the ROE or the ROA, or because we have five ratios. We have ROE, and then we have the ROA, and the ROA is actually broken down to the leverage multiplier and the profit margin. And then the other part is the other part of the breakdown of the ROE is actually the leverage multiplier. So you have leverage multiplier and the ROA, and the ROA is broken to asset utilization and profit margin. So please understand that if I give you some of those ratios, you can calculate them. The other thing, we talked about quantitative and qualitative, and we define quantitative and qualitative. We defined also internal and external. And if there is anything about this, will be a theoretical questions. This is the process, if you can look at it, but it's not really a huge issue. A huge issue is here, the DuPont model and how we calculate it. And actually, we have some questions discussed in the tutorial. Now, we also talked about different risk, OPS, interest rate risk, liquidity risk. You have to be aware. For example, liquidity risk, when we measure it, if you look at the slides, we measure it according to liquid assets over total assets. Now, the important thing is, what is the interpretation? Do you want this to be higher or lower? So if I have a liquidity risk that is, if the percentage is going up, that means I have more liquidity. If the percentage is going down, I have less liquidity. Credit risk is just the opposite, because it is it depends on, well, what is the credit risk. So when we have credit risk, which we have, for example, the non-performing loans over total assets, if this is increasing, so the credit risk is actually increasing. So it's not good. But when we see the credit risk going down, it's better. So you have to understand how to make interpretation of those ratios. And in that tutorial, we talked about some other ratios. For example, efficiency ratios, interest rate differential, liquidity risk, credit risk, all of those. If I give you some numbers, please be able to translate what does it mean and calculate it. But the ROE model, of course, there will be some questions about that. Now, bank capital planning, which is week 5, we talked about bank capital planning, and actually we talked about the type of capital. We talked about tier 1 and tier 2. We talked about the purpose, and we said that tier 1 is high quality capital because you can access it more than tier 2, which covers more risk per $1. So if we have tier 1 capital, which is actually the common stock, we can cover more risk if it comes more than when we have tier 2. Tier 2 come things like revaluation of the assets, which is actually not very good capital to access it when there is losses. You can still access it, but it's not as good as tier 1 in terms of its accessibility. We talked about the target capital. And when we talked about the target capital, I think you remember we have a model, and that model shows the, we talked about it in problem number 2 in tutorial 5, when we talked about the what is the optimum debt, and if we have the optimum debt, we can decide on the optimum capital. And I think you remember when we did that graph, and we showed that there is you can take more risk, but then there is always, you know, that quadratic equation which show you more risk is actually will be penalized by the regulation. So if you take more debt, actually, you will have more tax benefit. And this will increase the value of the bank. But you cannot continue forever. You have, when you started to take more and more debt, that means you have less and less capital. Regulators will not be happy about that, and they will start to penalize you. So as long as the benefit of the tax is more than the penalty of the regulator, you continue. And when the regulators started, the penalty of the regulator started to outweigh the tax benefit, then you have to stop. And this is why we have that U opposite U, reverse U shape, which we call it quadratic equation, where we can stop there. So if I give you, for example, the graph, please be able to understand it. We say who are interested in the bank capital, and we actually counted around 10 parties. Rating agency, debt capacity, corporate control, regulatory environment, future acquisition plan, availability, and then we talked also about the tax benefit, financial risk. If you add those 4 plus those 6 factors, we are talking about 10 factors. So only corporate control is calling for less capital, and tax benefit is calling for less capital. The rest are calling for more capital. So please be aware of that. Now, when we talked about capital also, we talked about 2 models. We talked about ICGR, and there will be calculation about it. And also we talked about the asset growth model. But one more thing, which is important, is that if we are depending on the capital, internal capital, which is coming from the net income, this net income will go to dividends, or we can hold it and we call it retained earning, and it becomes part of the capital. So actually, if we are growing and we want more capital because we need to give more loans, because we have to keep the proportional of capital to assets. And so the way we have more capital, we can give more assets. Now, the purpose then, by intuition, we will say, okay, we need more retained earning out of this income, which means we will decrease this dividends to 0. But this is not possible because our shareholders can be very disturbed by that, and they can leave the bank, and the investors may leave the bank. And therefore, there are 4 theories, which are those ones, and they are explained very well in the slides, and I think I touch on it a little bit on the tutorials. So you have to understand those 4 theories, and which one is calling for more dividends, and which one calling for less dividends, and which one is indifferent, like this one. Shareholder preferences is indifference, and you have to read about this. Now, when we decide on this, if we are talking about EGM, which is asset growth model, if we have as a bank decided in how much capital we will have, how much asset we will have, then in this case, we will use whatever the bank will give us from the retained earning, and the rest will take it from the external sources. This is if we talk about EGM. But if we talk about ICGR, now ICGR, which is internal capital generating rate, then we will depend only on the retained earning. Therefore, when we talk about EGM, as I told you, whatever the retained earning will give us, the rest we will have to get it from external sources. What are those external sources is actually these 3 sources: common shares, preference shares, or hybrid securities. Now, as I told you, this is the 2 models, and you should be aware of its calculations. And I think you have I will upload for you also the formula sheet where you can use them. Please understand the difference between the 2 models and how to calculate them. I don't think there is more to talk about it, but if there is any question, please try to talk to me, and I will be able to either email me or come to the consultations and we will discuss any further issues. For now, thank you very much, and I will stop this video and see you in class. Bye-bye.